we kill time, we save time. We rob time, we lose time. We have all the time in the world. But no one of us is powerful enough to stop the march of time or slow it down. Good morning, ladies and gentlemen. Welcome in this multi-time frame session where we will learn the role of the time frame in our trading. We know time, it's pretty important because when we decide to work with a trading time frame, we will affect the trading strategy, we will affect the indicators, and we will affect our attitude and our approach to the trading in itself. Some one of us would prefer to hold position for a long period, for weeks. Other ones would like to have a position for minutes. So to find the right time frame is not easy because we have different choices. But we advise to use multiple time frame analysis techniques because if we're approaching just one time frame, we have just a small piece of view of the business. If we have different time frames, we better understand the market. We better reading what the big money is doing, and we can improve the strategy performances. The multi-time frame is something that take a single time frame, consider that this single time frame strategy is giving a very limited view of the market and is try to widen our view. And this is the reason why we recommend multiple time frame analysis. But some of us can understand that if I'm comparing an M15 with an H4, I can have different information. So it's for some of us, the MTF can create a confusion more than clarity. So according to some of us, the multi-time frame is representing more a chaos than harmony. And go back to the history that we were talking about. You remember Dow Charles, Richard Wyckoff, with our monkey flipping the coin. I never thought about Munehisa Omna, that it's 300 years ago found the candles, the so-called Japanese candles. But now we have to add some important people in our gallery. The first one is Mr. Fourier. Fourier, the French mathematician, it's very famous for the Fourier series, the Fourier analysis and analysis of harmonical. A part of the study have been taken by the Marquis Guglielmo Marconi, so who invented the long-distance radio transmission based upon the harmony and the harmonic waves. You know that has been Nobel Prize. Another less known is Mandelbrot. Benoit Mandelbrot, Polish, French, American mathematician. He is the father of the theory of the chaos. But it's pretty interesting because he applies the theory of the chaos in financial market. And I said that in financial market, it's what we understand as chaos in reality is a different mathematical formula. He's pretty famous because he found the mathematical formula for cotton trading. And it's explaining scientifically why it was a Gaussian distribution or a Levy stable distribution. Mandelbrot, let's start from the last one, affirmed that the chaos is the size of surprises and teach us to expect the unexpected. Try to see how much is closed this sentence to our trading. Chaos theory deals with non-linear things that are effectively impossible to predict or control, like turbulence, weather, the stock market, or brain. So he's pretty famous for inventing the so-called fractals, where you say that everything that seems chaos, if we change the point of view, in reality is hiding a different form of harmony. So when we change the point of view, when we zoom in or zoom out, we can find a different harmony. Fourier, it's pretty important for his harmonic waves study. So he said that when we have one wave, like this one, combined with another one, is creating the fundamental wave, the resultant, also is called in mathematicians. Like this one plus this one is forming this one. These studies are pretty important because when we have the so-called harmonic waves, okay, we can have one waves here, for example, a third one that is coming here. The resultant is totally different, but we can see that there are points of confluence. Marconi applied the same mathematical approach to the radio waves. And they say that it's, yes, we have different harmonics and we have the fundamental. If you remember, in the old valved radios, the sound of the speaker was fading and coming back, and fading and coming back. Because what Marconi found that in sometimes we have the so-called constructive interference. So when the harmonic waves, like these plus this, are running in the same direction, the final signal is stronger. And then he found the disruptive interference when one harmonic is running in one way and the other is running in the opposite way. And in this case, the resultant will be weaker. So we have a constructive interference and we have destructive interference with these results, stronger or weaker. So to go back to our topics, okay? The global economy has also waves and cycles. We have the so-called secular cycle that it's around 20-30 years, then business cycle, then tactical cycles and whatever. So it's all the cycles are representing a peculiar moment, but all together they have to follow the same pattern. And just if you want to spend 5 minutes interesting in Googling, there is a theory of the 19 years cycle that says that the economy in the world has cycles of 19 years because every 19 years the sun, the earth, and the moon are aligned. And so according to this theory, and it's proved, that the economy is changing. We see that in trading application also, when we have trading, we can have big cycles according to the bigger time frame, medium, and smaller cycles. And any wave that we see, if we change the zoom and zoom in or zoom out, is presenting other waves, okay? But everything has to go according the resultant wave, the fundamental wave. So probably you start to see the picture. If we have different time frames, okay, it means that we have different harmonic waves. And the market is not moving in chaos, but the market, the final market, like this one, the blue one, is the resultant of the mathematical results of different waves. But these waves sometimes are constructive and sometimes destructive. So if we take, for example, the previous example, question is, where do you enter into the market? Here, where we have one up, one down, one up and one down, or here? Any single wave, in some moment, they have to confluence in the same direction. And when all of them are in the same direction, we have a constructive interference here and here. Just pretty interesting. If we see Fourier, Fourier found that adding a third harmonic to a second harmonic to the first harmonic, we found these resultant. But this resultant, by chance, is pretty similar to the Richard Wyckoff market logic. We have accumulation, we have trend up, we have distribution, trend down, consolidation, accumulation, distribution. Mathematical point of view, this is different harmonics in different time frames generating the final result. So we have a conclusion, the first conclusion, and then we will see the practical application. The first point, there is no chaos in market, but there is a different form of harmony. I suggest, but this is my personal opinion, okay? You can find different approach in different books. I suggest that to consider different time frames has different harmonic waves, and the market will be the resultant. Consider that waves have constructive and disruptive interferences, and if you enter in a disruptive moment, you are done. You didn't pay attention, and we know what will be the result. So let's see what we can do. We have to wait for the positive global moment with a very simple rule. We use the higher time frame as trend filters for trading BS, and we're using the lower time frames as entry point when the waves are aligned. I repeat, the higher as trend filter, the lower as entry point. Let's see concretely. What does it mean, the lower or the higher? If you are working on a daily time frame, for you the higher will be the weekly. For the H4 will be the daily, H1 will be the H4, and so on. And we take note about a couple of lower, okay? Let's see, normally we suggest minimum one, of course, but maybe interesting also to see two higher time frame, but this is a suggestion. But for lower time frames, we need at least two, because we need to see the confluence of the constructive interferences. So, higher time frame trend filter. What does it mean? Let's say that I'm trading in this moment in H4, in this example. So it means that I will check D1, and I will check if it's showing an uptrend, like in this case, or a downtrend. So if it's showing an uptrend, like in this case, I will enter only long positions because we are doing trend following. If I'm opening a short position, it will be a reversal trading, that it's okay, no problem with that, but this is not the style that we are suggesting for the moment. It's pretty advanced. So the first one, check in the higher time frame, check the trend. If the trend is uptrend, we will enter on the long, and vice versa for short. And then we will check the two lowest time frame to look for the proper entry point, because if they're aligned in the same direction and are they coherent with the higher time frame bias, it's okay. And then we will enter, this is the most important rule, when I will see the end of the retracement in the faster time frame. This is very important. I will check. So again, I'm working, for example, in H4. I'm checking H1 and M15. They are aligned, constructive interferences. Okay, perfect. They are coherent with the higher time frame, long, long. Okay, perfect. When do I enter? When the faster time frame is showing the end of the retracement. Here we have a long position, short retracement, long position again. I try to enter here as soon as possible. So the retracement is very important because when the market is going up, for example, the retracement is a temporary reversal of the price within the major price trend. And the within is more important because the retracement is ending here and the initial move was starting here. So the retracement has to be smaller than the initial move. If not, it's no more a retracement, but it's a reversal, that it's totally different. So I'm using always the example of the swing, okay? It's the market, we know that it's going as a swing from one side to another, up and retracement, up and retracement. We have to enter, we have to push the swing when the swing is in the proper position. So it's going up, retracement back, and then we push. Retracement is very important because the proper retracement is a confirmation of the trend. So the retracement is helping us to find the good context of the great trade. And normally we have to wait the end of the retracement. Why? Because if I'm waiting for the end, I'm sure that it's a retracement and not a reversal, first of all. And most probably, I'm not going to be faked out by a false trend, but it will be a real trend. So concretely, if I have a trend here, and then I have a retracement, I'm waiting that is moving up a bit, let's say 2 or 3 candles, to see that the retracement is going properly up, and then I will enter. Another very, very important person in our gallery is Mr. Leonardo da Pisa, the son of Bonacci, so in Latin Filius Bonacci, and is very well known as Fibonacci. He's the biggest European mathematician in the European Middle Age. It's pretty interesting because in Europe, and that in his period, they were using Roman numbers. He was from Pisa. Pisa was very involved in trading. His father was a trading, and they were working in a trading station in Algeria. In Algeria, with the Arabics, he learned the Hindu-Arabic numeration system that then became, let's say, our system with Liber Abacus. He found one of the most important laws that Leonardo da Pisa found. He found the law of harmony. It's called Sectio Aurea. It's called Fibonacci series. And this rule is present in everything that we consider harmonic. And the Fibonacci is very heavily present in trading, but this will be a separate session in our education. So, ladies and gentlemen, thank you for your attention, and I hope to meet you soon to talk about also these wonderful multi-time frame trading.